So following on from our live lecture this week, we're going to finish off the indirect method, looking at the same example we've done from before, and we should get the same answer. So indirect method. So the starting point is going to be profit after tax. Now we'll show you here, you can start with profit before tax as well, just depending on which adjustments you use, but it's better off being consistent. You can also start with operating profit. You just won't have the interest and tax expense adjustments here. So there's a bit of subjectivity and leeway in terms of which profit figure you start with. So if we go back to the previous example here, which is strata, your profit for the year here was 429,400. Your first approach then is your what we call your non-cash adjustments. Now these non-cash adjustments are items that might be in that profit calculation, in that profit figure, but they're non-cash, so they should be stripped out. We also then have the tax expense we know is in part of that, so we're going to add back 185. So essentially by doing that, we're back to the 614,400. So if you started with profit before tax, you could leave that adjustment out. If we had interest here, you added that back, you could start with profit before interest and tax, which is otherwise known as operating profit. So there's a bit of leeway, as I said, where you start. You're also going to add back depreciation because depreciation is in that calculation. It's 86,000. And the reason you're adding it back is you're saying, well, it's not cash. So it's actually your cash flows are not going to be 86,000 lower. That's merely an accounting adjustment. So it's a different way of laying it out than you might be used to, but it's important that you understand how to approach both ways. So that's our first two non-cash adjustments. You come down here and you'll see the layout. We don't have any interest expense. We don't have any profit on disposal. So what we're going to do there then is we're going to do a subtotal. So our subtotal after the non-cash adjustments get us to 700,400. Now we're going to go on and we're going to do our working capital adjustments. Now we're going to call this working one, and we're going to look at movements in inventory, movements in trade receivables, movements in trade payables. So we come down here and we look at our working one, and we're going to lay them out. Inventory, trade receivables, trade payables, and we're going to look at opening balance, closing balance, and movement. So the key thing here is we know if we have more or less inventory, if we have more or less trade receivables or more or less trade payables, that influences our cash flows. Because we're making credit sales, we're making extra credit purchases, we're plowing money into inventory, which is either going to be a drain or a source of cash. And how you approach these working capital adjustments is you look at, compare the opening and closing balances. So for inventory, the opening balance 148,500, the closing balance 134,200. For trade receivables 189, 215,500, and trade payables 141,250, 152,900. So if this was the direct method, you would be looking at putting those into maybe T accounts and using them for a particular purpose. Whereas here, what we're looking at is, let's tidy those up, we're looking at the movement. Now, I don't use negative figures, so I'm just going to look at the overall movement, and that is a 14,300 decrease. So your inventory has decreased over the year. In this case, it's an increase of trade receivables of 26.5, and it's an increase of trade payables, if I do correctly, of, sorry, that's an increase of trade payables of 11.6. Now, the key point here is when you calculate the movements, we now need to know is the cash flow impact. So what we need to think about is, well, is an increase in inventory good or bad for cash flows? Is an increase in trade receivables good or bad for cash flows? What is the impact on cash and cash equivalents? For inventory, a decrease is positive. Why? Because you have less money tied up in inventory, which means it's going to release cash to the business. So what you're actually going to do there is you're going to add the 14,300. It's a positive impact on cash flows. For trade receivables, this is a negative impact. If you have more trade receivables, that means you have made sales but not received the money. So people owe you money. So you don't have it in the form of cash. So it's a negative. and that's going to be a minus 26.5 adjustment. For trade payables, be careful, this is positive. So in inventory and trade receivables, they're the same adjustment. Decrease is good, increase is bad. Trade payables are the opposite. An increase in trade payables has a positive impact on cash flow. Why? Because that means you owe people more money. So it means you haven't paid them. So it hasn't come out of your bank account, so it hasn't been a drain on cash. So we come up here, inventory is going to be plus 14.3. Trade receivables is going to be the movement, but it's going to be negative, minus 26.5. Trade payables is going to be positive, plus 11,650. And they're what we call the working capital adjustments. So when you add those working capital adjustments to the 700, you thankfully get cash generated from operating activities, generated from operations, to be 699,850. And if you remember from above, there's 699,850. Same as the direct method, albeit presented differently. That's why the indirect method is often a bit easier for students to do, because it's like one big step rather than 3 or 4 different steps that the direct method require. But one of the hardest ones for students to get their head around is this aspect, is movements in working capital, increases and decreases have impacts on cash flow. And how you deal with them is you put in your adjustments, either positive or negative. So think about it as an example. Let's use trade receivables. We know in the profit figure, the 429, there's been revenue recognized of 2,145,600, getting to that 429. However, we also know that trade receivables have increased year on year. So actually not all of that 2,145 is cash. We know the increase year on year of 26.5, that's not received. That's merely been an increase in trade receivables. How we would have dealt with that in trade receivables in the direct method is you did a T account and you use directly the 2,119,100. How we deal with it down here is we take off 26.5. So you're essentially getting to the same figure. In here, the 2,145,600 is used. But we're saying 26.5 needs to be adjusted. So if we take off that 26.5 off the 2,145, you get your 2,119,100. So you're making the same adjustment, getting to the same figure to use in a different way. In the direct method, we use T accounts. In the indirect method, we look at the net movement, and the hardest part is figuring out should it be a positive adjustment or a negative adjustment. Now that is hard, but it's important to go back and remember inventory and trade receivables are the same. Increases in them is a drain on cash flow, decreases on them is positive for cash flow, and trade payables is the opposite. So if you are using the indirect method, make sure you're comfortable with that logic of where it comes from. But in both of those methods now, the direct and the indirect, we've come to the same answer overall, 699,850 for both. Okay, that's your first key point, and I'll come to it again in a second in question 1 in your question pack. In question pack 7, make sure you go back over that where I ask you to look at another example similar to the one of the slides but with different numbers to calculate cash generated from operating activities using direct and indirect, just to see can you hammer home the key approach to both, and secondly, can you get the same answer, because these are using the same numbers, just presenting it in a slightly different way. Now, the other key aspect in cash flow from operating activities is calculating tax paid and calculating interest paid. So we're going to look at 2 little examples of this, because the tax figure that you see as an expense in the statement of profit and loss may not be the tax figure that's actually paid to the revenue authorities. So when you're looking for tax paid, you need to use a T account approach again. So we're going to open up here a tax account. Right, so we're going to open up there, tax, similar to what we've done above. And we're going to figure how much is tax actually paid. Just line up that so it's easy to see. So the first aspect is, if you look at this small example, we have a tax expense for 2019, but we owed 15,000 at the start of the year, which is the end of last year. Now we only owe 10,800. So the balance brought down at the start of the year was a liability, 15,600. At the end of the year, the balance to be carried down for next year is 10,800. And during the year, you would have debited tax expense, credited tax liability, 108. So what we're trying to show you here is if there's movement in liabilities during the year, it means the tax expense is not going to be the same as the amount of tax paid. And it's tax paid that should go in to your statement of cash flows. The expense is the expense incurred. That goes into the statement of profit and loss. But the amount physically paid over, i.e. credit bank, is what goes into the statement of cash flows. So your credit side here is 123,600. So both sides must be that. So the balancing figure here is bank, which will be debit tax as we are doing here, credit the bank account. So it's a cash outflow. And that will be 112,800. So that's the amount as a negative figure you would put in tax paid. Right? 112,800. And it will be a negative figure. It's an outflow because you're crediting bank, which would be a separate T account, debiting the tax liability. So you use the figures in the statement of financial position and you use the figures in the statement of profit and loss to solve a puzzle. What you're looking for, what is the plug figure? The plug figure is the figure that goes to the statement of cash flows. Very similar approach to interest paid. If we have the finance costs for the year, which are expenses, we call this interest accrued or interest owed at the year end. So if we know, for example, what the interest expense for the year is, if we know how much we owed at the start of the year and how much we owed at the end of the year, we can figure out how much interest do we actually pay during the year. Right? So some people won't need a T account as they go through, but particularly at the start, as you're learning it for the first time, start to use a T account. Start to think about debits and credits, because in a statement of cash flow, you're going to be doing a lot of these adjustments. You're going to be given a full statement of profit and loss. You're going to be given a full statement of financial position, and it will be up to you then to see can you get the statement of cash flows to balance. So interest accrued at the start of the year, which is the end of last year, 40,000. Interest accrued at the end of the year, 60,000. So you actually owe more now at the end of the year than you did at the start. And it would have been debit finance costs in the P&L, credit interest accrued. So it should be 190 both sides. And that means the amount you actually paid was only 130. So even though your finance costs in the P&L were 150, you owe 20,000 more at the year end. So that means you didn't pay all that you incurred during the year. You only paid 130, which is why the 40 has gone up to 60. So you're using the information to solve that puzzle. I have the opening balance, I have the closing balance, and I have the amount of expense incurred during the year. With all of that, you can then work back and figure out what was credit bank, debit, interest accrued. And it's those two figures then that will go into the end of the net cash flow from operating activities. There's your interest paid, there's your tax paid. And that gets you, as we looked at in Glambia, your net cash from operating activities. I said I'll talk about interest received later on. That's a bit more subjective. It doesn't always go there, but interest paid and tax paid will always go into the operating activities section. And in your loop page, you have a template that's given, and that's the way the template is laid out. Cash generated from operations can be either the direct or indirect method, and then you take off interest paid, which is probably going to have its own working, or tax paid. Please note another important thing to watch for here is if there isn't any opening or closing tax liability, or if there isn't any opening or closing interest liability, well then whatever you paid incurred during the year, the P&L item, will be the cash flow item as well. So it will be debit finance costs, credit bank, or it will be debit tax credit bank. So if there's no liability, you don't need to do a T account. You take the profit or loss statement directly. But in most exam questions, you will have to make an adjustment for opening or closing liabilities. So you'll need to see the links between statement of profit or loss and the statement of financial position as well. So it's important you go back and practice that from the question pack before you go on to larger questions, because these are ones that are quite common in nearly every statement of cash flow question. All right. So what is the summary then for the indirect method? You start off with non-cash items, such as depreciation or profit or loss and disposal, and you adjust for those by taking them out. You then adjust for working capital movements, which we'll look at in a second of the rules. Then you take off interest and tax. Please note these two are different than the direct method. So there's different approaches. Interest and tax paid are the same. Same approach, same figures, whether you're using the indirect method or the direct method. So don't be too worried about thinking there's any differences there. There isn't. It's up until that figure, up until you'll see here the cash generated from operations. That's where the differences are. Direct method is a more columnar, indirect method is a more columnar approach. The direct method has a lot more workings where you lose a lot more T accounts and adjustments. That's why it's not as intuitive and it's not as useful for investors and other stakeholders when they're looking at a statement of financial position and statement of cash flows. So if you look at, for example, Glambia, it says cash generated from operating activities. It gives us a note 32. So if we go to note 32, go on a little bit. Note 32, you can see here it is using the indirect method, starting with profit after tax, adding back items, taking off, adding back depreciation, and then dealing with your working capital adjustments as well. So in note 32, you get your 285 million, but it uses the indirect method. So if you go to other ones, they may use the direct method. If we go to, for example, Kerry Group, which is another annual report that you have, we look at their statement of cash flows, which is on page 154. They use the indirect method as well, starting with profit, making their adjustments, and getting cash generated from operations. So a lot of them will use that indirect method. It's not the only one, but it's probably more popular. Similarly for CRH, if we find their statement of cash flows, these are all the accounts that are available on Loop. Consolidated statement of cash flows, again, they start with profit, they adjust for particular items, they add back depreciation, make non-cash adjustments, and then they adjust for working capital as well, which gets your cash generated from operating activities, take off interest paid, take off tax paid. So it's quite a popular approach to use that indirect method. And different notes then tell you where different items are. So if you want to see what's their movement in working capital, you go to note 21. If you want to see where they're getting their finance costs from, you go to note 10. So it's quite a similar layout, and that's why we have IAS 7, is to standardize the approach to the layout of a statement of cash flows to allow comparability year on year in the same company or across companies as well. So I said your three adjustments then is inventory and trade receivables are the same. An increase is a reduction in cash flow. A decrease is an increase in cash flow. So these two have the same rule. Trade payables has the opposite rule. And that will take a bit of getting used to. Practicing that you understand the calculations and you understand the why as well. Why are these adjustments needed? Why can't we just ignore them? If we ignore working capital adjustments, it's not really going to work out. You're going to ignore the fact that there are certain movements, trade sale, credit sales, credit purchases that are impacting your revenue figure or purchases figure, but not impacting cash flow. So you have to make those adjustments as well. Right? So what I want you to go back and look at now is look at question 1 in the question pack. Do the direct and indirect method again. Hammer home that you're happy with how to lay out both, which one you're more happy with, and go back and look at the layouts then. Look at the sample templates that I've given you. I've given you a template of overall set of cash flows, but I've also given you a couple of annual reports. look at Glombia's, look at Kerry Group, look at CRH's, and how they lay out cash flow from operating activities. There will be certain line items that won't make sense, that will be beyond the scope of this, but look for the ones that do make sense. Look at how they start with profit, what adjustments they make, and look at the steps they go through. Right? It's quite repetitive, and the more questions you can go through at this stage, the better. And certainly from a textbook perspective, the Margaret Darcy textbook that you would have used in AF1, particularly chapter 20, will be very useful as well. And that should be available in the library.